Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering our stocks with ex-dividends next week. So of course, if you haven't tuned in before, all we do is we look for ex-dividend dates coming up next week. We get a range of 40 stocks. We screen them for PE under 25, yields over 2, increasing in revenue, net income, and we take a look at other statistics, and then we take about 40 stocks and narrow it down to around 5 or so different stocks, and that gives us a really good idea of what sort of stocks to kind of dig deeper and read their 10Ks, go over their last quarterly reports and such. So I haven't wrote up the article yet. I was very busy at work today, and I had to drive out to a couple cities away after work to replace the switch. So I'm going to go ahead and just do this with you guys, and then I'll write up my article afterwards. So let's go ahead and get into it. I have white charts here on the left hand side, which I have a video on how you can access that for free. So go ahead, click on the top right corner, queue it up, and you can see how to access it for free with the financial metrics that I use. Now over on dividend.com, I'm going to go to ex-dividend dates. And then I'm looking for some common shares. So I'm going to go ahead and deselect all of those. And we're looking for next week between April 9th and April 13th. Can you believe how quick time is flying right now? And then all we want to do is hit search. That's going to give us all of our ex-dividend dates for next week. Next, I want to sort it by the DARS rating. And I talk about the DARS rating on all these videos. It's basically the strength of the stock, the next 4 quarters, its earnings, its earnings expectancy for the next 4 quarters. How long has it been paying dividends? What's the yield? How often do they increase it and increase it by X amount, and all sorts of different strengths. Basically, it's like 5 or 6 different rating systems, and then it gives it a scale. So what we're going to do here is we're going to go ahead and add all of 3.4 and above into our Y charts. So over here on the left hand side, all we have to do is just type in these ticker symbols, and you're going to see that after a few minutes, whoops, that's MOV, we're going to go ahead and move all of these over here. So these videos usually turn out very long. So what I'm going to be doing here is I'm going to go ahead and pause it, enter all these tickers until we get to the 3.4 ones, and then I'm going to come right back. So I'll be right back. Okay, and we're back. So what I did here is I took all these stocks rated from a 5.0, and there were only a couple of 3.2, so I actually included in my list here. You can see down here towards the bottom, I have TD, TOL, and EBF. So that is my cutoff mark. So I included roughly about 40 stocks here. So all I'm going to do is go ahead and move this here. Actually, I'll go ahead and expand this to the full screen because we no longer need dividend.com for right now. We'll come back to that here in just a minute. So we have roughly 40 stocks here. Now our chart can't handle all these stocks all at once. So what I like to screen for first is the PE ratio. So I like to take the PE ratio here and select it. That's going to allow it to pop up here, but that only happens when I have roughly only 10 stocks selected. So I go ahead and deselect all of these stocks down to about 10. Now already there's a few names in here that I recognize, such as Verizon, Macy's. I haven't seen AT&T. AT&T should be right around here as well, but it probably didn't get rated as high as Verizon. So this is just a very good way of finding a whole bunch of stocks that I don't commonly look up. So there's a couple in here such as Abbott, AbbVie, Verizon, Macy's that I really actually, I've heard of these, Dollar General, but there's a whole bunch of them that I have never heard of. So that's why I like doing this process. So here I have roughly 10 stocks selected. On the right hand side, you're going to see PEs from the lowest to the highest. So I'm going to go ahead and remove the ones that have a PE ratio over 25. So this process, this whole screening process goes by very quickly. I can pretty much do it. Let's see, banner here is towards the bottom. It takes between 5 to 10 minutes depending on the list size and such. So here we are, Glacier Bancorp. That's the last one over 25. So all I do here is I uncheck these down and recheck the next batch of about 10 stocks. And then we just again begin removing them from the list. And if you take a look here, 1, 2, 3, 4, like this color right here, the green one, over here it shows you the green indicator, so it's the fourth stock listed. So basically you just have to count down 4 and remove it. So here, pink one is at the bottom, so we remove the pink one. Orange one is second from the top, remove second from the top, and now everything under 25. Now I use 25 because 25 is right about the average of the S&P 500. I always like to gather stocks that are at or below the S&P 500. So here we have a dark blue, which is right here, almost in the center, Inuit. So go ahead and remove that. Again, another dark blue candidate. And now we're looking for the green, which is second from the bottom. Orange, second from the top. Graco. And we have sort of like that Ravon pink, second from the bottom. So all I do is do this little process here. And again, it takes about 10 minutes, but that allows me to screen about 40 different stocks that a lot of these names, I don't care about the names right now. I'm not trying to pick any favorites right now. All I'm trying to do is use the financial metrics to kind of, basically just trim the fat. And we'll talk about here in just a second. So I'm going to go ahead and pause the video, go through the last remaining ones, and we'll be right back. Okay, we're back. So we actually got, pretty good amount of stocks that have PEs under 25. Next, you can go ahead, and this is up to you. Do you want a yield of over 2? Do you want a yield of over 1? I like to remove stocks that have dividend yields under 2 just for, just for giggles. So I'm going to go ahead and remove Johnson Outdoors, because if you're investing $100, you do want the appreciation, of course. You want to choose great stocks, but at the same time, you also want to invest for the dividends. So if you're investing $100 at a 2% yield, you're getting roughly $2 back per year for that yield. So right now, we're at really high peaks right now, so the dividend yield may be a little bit low on some of these, but the ones that do have yields over 2, they could have went through like a rough patch, cause your yields to go over 2. Their price is down low right now, which means they could be great buying opportunities. So I think 2% is a pretty solid number. 2 and 3% are some of the most common yielding stocks on the market. As you get into the 5 to 6% range, they become more uncommon, and they become a little bit more risky, or they don't have as great appreciation as some of the other stocks that have yields in the 2 to 3% range. And even there's stocks that are below 2% that I've actually invested in. So this isn't an indicator that they're bad stocks. Orange is Werner. Okay. It's just for this whole process here, I'm just trying to divvy it down to about 5 to, around 5 different stocks. So again, here we have quite a few here. McGrath's, Rent Corp, that's below 2. We have Science Applications. So this whole little process, it just sort of really thins it down to a list of stocks that I don't pick favorites. So this whole process, I always go through the same process. Whether they're big names or not, it doesn't matter. I don't pick any favorites when I'm doing this list. I read the name off, I look at the numbers and remove the stocks that don't meet my criteria. So here, for example, Lincoln National, which is the second one here, gets removed. Trizio dividend, it's basically just Trizio, and there we are. So now we've thinned it down even further. We're only left with screening 4 more stocks, and 2 of these, River and Toll, automatically removed. And now we're left with dividend stocks that all have yields over 2% and PEs under 25. So already our list is down to 15 from around 40 stocks. So that's a pretty quick elimination. Next, I'm looking for increasing free cash flow, net income, and possibly revenue over the last, let's make it difficult. So we'll say 5 years. We'll say 10 years. And let's go ahead and hit the percentage button. I like to use that, look at it as percentage. That I can see over 10 years, what have they done, on average per year. So this one's lost roughly 410% of free cash flow. So they've been on a downward slope in their free cash flow. Their revenue is down 8% over the last 10 years, which means about, they lose about 0.6% of their revenue every year over the last 10 years. So I don't like to see any negative as far as revenue and net income. So I go ahead and just chop those off right away. Cracker Barrel, this one's actually positive in their free cash flow, their net income, and their revenue. So I go ahead and move on to the next one. Again, another positive one. Hormel Foods, positive. Darden Gardens, positive. Campbell's Soup, down in net income. Ethan, down in net income and revenue. Macy's, surprisingly, all positive. OGE, negative, negative. So negative free cash flow, negative revenue. Their net income is up, but I like to see those numbers positive. Negative net income, negative free cash flow here. General Mills, all positive there. Bank United, all positive there. Time Warner, negative in the free cash flow, but they have positive net income and revenue, which is, that's actually great. Negative free cash flow, that could just mean that they've been going through acquisition after acquisition, acquiring smaller companies. So if you had a smaller list of stocks, say you had thinned it down to three or two to three stocks already, you only had remaining, you could skip over negative free cash flow. But because we have so many stocks already up here that have passed the positive net income, positive revenue, positive free cash flow, because in times of pullback and recessions, that free cash flow is going to be important. Because if they need to, that company, if they don't meet their earnings, they may need to dig into some of their free cash flow in order to pay the dividends and just continue to pay positive dividends over the upcoming years. So here, there we are. So we have 2, 4, 6, and 8 stocks that all have dividend yields over 2. Price, let's see here, what else? PE ratios under 25 and yields over 2. Now, as far as another process goes here, I like to take a look at yields over price, but I don't knock them for having a yield over price right now. I think my data is a little bit, there we go. So yeah, yield over price there, price over yield, price over yield, yield over price, price over yield, yield over price, price over yield, and price over yield. So there's actually a few of these that I would consider, just kind of looking at the numbers, that were above their yield for a while. So like Cracker Barrel, for example, they had a price of over $170, where their yield was down below 2.65, but now within the year their actual yield has moved above their price point. So right now they are trading below, the price is below the average for the year, and their yield is above the average for the year. So I would consider this a possible undervalued stock at this current time. So because we have so many stocks, I may end up just thinning it down. I don't want to do that either. So let's take a look at what else can we thin it by. Normally we don't have this many stocks remaining. And price to book value, this is not a good one that I like to thin stocks down for, because these are, yeah, there's quite a few there, and I don't think it's actually bad. So what we can do is we could take a look at the actual numbers without percentages wise, and just kind of see how big these companies are and how much net income they have. So I know a lot of investors, they like to be invested in companies that are generating at least billions of dollars of revenue and a couple $1 million of free cash flow and net income. So we'll go ahead and use that as an example. So we want, okay, so they have a couple million here. Million and billion. Billion and million. Billion and billion at Macy's. Billion and billion. And billion and million. Billion and billion. Yeah, lots of billion. Okay. So I guess I could use all 5 of these. Let's see here. I've never had this come out like this before. So let's just look at 5 years and which of these stocks are positive over the last 5 years. Economic growth, yeah, we're going to have like the same sort of numbers here. These actually Macy's there. Retail. We'll go ahead and chop that one off right now. General Mills over the last 5 years, they went down in their net income, their free cash flow, their revenue has came down over the last 5 years. When times of great opportunity, I suppose, we'll go ahead and just thin that out, and that's going to give us a little bit less stocks to be involved in, but we're still up. So we have 246. So that's basically it. I'm not going to thin it down any more than that. So we're going to go ahead and have 6 stocks here. Now, what we're going to do from here is we're going to go ahead and take a deeper look at these specific stocks. So all I'm going to be doing here is looking up the tickers and then opening them up in another tab. So the other one here is CAC, Hormel Foods, DRI. Where are you? Right there. BKU, which is, just use our search, BKU. And then our 6th one is TD, Toronto Dominion Bank. Dominion, yep. So let's go ahead and order these right off the bat by how long they've been paying dividends. So Hormel comes at 51 years, followed right behind by Cracker Barrel at 8 years, and then Camden National Corp at 5 years, DRI at 1 year. It's actually a restaurant, surprising. I wonder what companies they hold in their chain. BKU is Bank United here at no dividend increases over the last few years. Just taking a look at how often, yeah, so they've held the same dividend in place since back in 2013. So what's their yield at right now? So their yield doesn't climb very high. So this one's had no dividend growth. We're looking for dividend investing stocks, so I'm going to go ahead and thin that one out. Again, these ones only have 1 year of dividend growth. I'm not sure how long these have been in business. This one looks like it pulled back a little bit here in 2016, but has had some pretty good dividend payments out in the past. So I'll go ahead and keep that one here. This one is unknown as far as if it's qualified or not, which is a foreign money center bank. It's been paying dividends for 1 year. So what I'm going to do here is remove that one as well. So what we're left with here is Hormel Foods, which is right here, Cracker Barrel, CBRL, CAC, Camden National, CAC, and DRI, Darden Restaurants. So those are the 4 stocks we're going to be including in this week's sort of review. So this one, Hormel Foods, has 51 years of paying out dividends, 43.6% payout ratio. So of their earnings, they only pay out 43%. So even during times of recessions and pullbacks where their earnings may not be so great, they may still have just a 70% ratio or so. So they can definitely withstand recessions. Since they've been paying out for more than 51 years, they've been through multiple recessions. This one does currently have a yield over price. Let's go ahead and switch it back to the unchanged. So they're currently sitting at nearly a 3.0 dividend yield in comparison to their price, which is 160. So this could be a great opportunity to take a look over their 10Ks and see if the stock is worth investing in. Number 2 is Cracker Barrel. Actually, that was the one we were just taking a look at. So let's go back and take a look at Hormel Foods. So almost average right here. This is about break even. You can see that their price did come down back in October, down in the $30 mark. I know I had purchased this one back some time ago. I no longer hold this stock. I had considered it for buy and hold for the long term when I was investing in straight dividends. And my initial plan was to buy and hold for multiple years, but because, different plans now. But still great stock. And let's go ahead and take a look at some more information here. The ex-dividend date is on April 13th, which is next Friday. Cracker Barrel, his ex-dividend is on April 12th, which is Thursday. Again, another 12th for Camden National Corp. So that's again another Thursday. And then April 9th, that is a Monday. So if you wanted to buy these in a specific order, you would need to buy them at Darting Gardens, DRI, on Friday or prior to be eligible for the payout date or the payout amount on May 5th. So if you had $100 invested in a stock, you would roughly get $2.98. And if you bought complete shares, like say you had one complete share, so you paid nearly $100 for the stock, you get paid out $2.52 for that share. So that's pretty good. That seems like actually a lower yield for what they're currently paying out. So maybe they may have increased their dividend recently. No, it looks like they're due to increase their dividend here. Last time they increased it was back in March. So the next upcoming dividend date after this one, it's already been declared, may get a dividend raise. Cracker Barrel again, April 2nd, that means you need to buy them on April 11th and hold them until April 12th. Then you get paid out on May 7th. Camden National Corp, same thing, buy prior on the 11th and then hold until the end of the month. You get paid out that dividend. You can sell on the ex-dividend date, but you can't buy, even in pre-market hours, you can't buy the stock pre-market on the same day and expect to have held it on the ex-dividend date. And then Hormel Foods, you have to buy it on Thursday or prior to be eligible for that payout on May 15th. So that is it for this video. I'm going to go ahead and have this information written up just nicely on my website with these 4 specific stocks, and kind of like the breakdown of how we explained it on that website, on the website. So check for that in the link below in the description, and also in the comment section I'll have a link to that article. And without making the video too long, that's it. So of course, I do want to thank everyone for watching up until this point. If you did enjoy the video, remember to like, comment, and subscribe for future financial videos. If you guys hold these 4 stocks in your portfolio, go ahead and let me know in the comment section below. I do not hold any of these stocks, and of course, as a friendly disclaimer, I am not a financial advisor or tax professional. The information provided is my opinion for entertainment and fun. This is not investment advice. This is just me as a financial investor trying to help others make their money work for them. Taking a look at what stocks are coming up next week, and then we screened roughly 40 stocks down to 4 stocks. Again, these all have increasing revenue, net income, and free cash flow over the last 10 years. And let's just see, over the last 10 years, if you had bought them, where would the price be right now? You'd be up 338% if you bought Cracker Barrel 10 years ago. Camden National, you'd be up 96%. That's again an average of nearly 10% per year. If you had bought Hormel Foods, or 10 years ago, you'd be up 225%. And if you had bought Darting Gardens 10 years ago, you'd be up 170%. So that's 17% return per each year average. Hormel Foods 22.5% average. What's this? A little under 10, like 9.6% every year. And Cracker Barrel 33% average per year. Except for 2018, they did have a bit of a weird year on 2000. After 2016, it looks like they fell very hard and has not had a lot of progress since then. So the majority of their gains was coming out of that 2008-2009 recession, and then just have been moving up since then. Again, these are dividend stocks, so as long as you buy and hold these for the long term, they're great paying out stocks. And that's it for this video. Thank you guys for tuning in. I will see you next time. If you have any questions, leave them in the comment section below. Thank you. Bye.